Hey guys, welcome back to the channel. My name is Tao and this is Taofi, where we talk about macro, finance, trading, and investing. So I wanted to take a little bit more time to do another deep dive with you guys this weekend. So I've been reading this book called Market Wizards by Jack Schwager, and it goes into some of the best traders and investors known here. And the book was written in 1988, but a chapter that really stuck out for me was a chapter with William O'Neill, where he basically goes over the 18 major mistakes that investors and traders make early on. So I'll cover those 18 mistakes with you guys, and we'll see, sprinkle a little bit of my experience with it as well too. And I hope you guys learn a lot from this video. So let's dive in. So for number one, William O'Neill goes into the first step is most investors can't even get started out of the gate correctly. What he says is that a lot of investors pick 4th, 5th, 6th place winners, and they're not that exciting to talk about, and they're not really market leaders at all. And I fell down this trap myself too. When I first started investing and trading, I was buying cheap, and we'll talk a little bit more about cheap stocks, but I bought no-name stocks, basically not market leaders. And what happens is that when they're not market leaders, they're going to continue to lag behind those market leaders, and that the market leaders are there for a reason, and they outperform everybody for a specific reason. So number two that Williams O'Neill goes into for worst mistakes that investors and traders do is buying on the way down. So as the prices are sliding for a stock, a lot of investors think this is a great deal and it's a bargain, and they continue buying down and averaging down, as they say. And what's really detrimental about that is that you're actually adding to your losers, which is a very bad strategy. What you want to do, and we'll talk a little bit about it later as well too, is you want to add to your winners, and you want to average up rather than averaging down and then averaging on your losers. It goes into our other strategy of having an exit plan and having stop losses. When you average down, the stock is declining for a specific reason, and so you don't want to get more into that. It's as long as it hits your stop loss, that's when you really want to get out. I fell down this trap too myself when I first started. I would buy stocks, and once it dropped $5-6 or 10-20%, I would buy more, thinking that I got it at a better deal. But getting it at a better deal meant that the market knew something that I didn't know. So hopefully you guys don't fall down this trap as well too. So number three that Williams O'Neill goes down, it ties back to averaging down, is that because of averaging down, you're actually making your losses worse. You're actually compounding your losses, and with that compounding losses, the stop loss that you had, or that you're gonna risk losing, let's say $100, you actually risk losing 20, 30, 40, 50, $100, 2x times more. I also see this a lot with the casino and people going to gamble and putting bets. They try to make their money back, and they basically lose it all as well too. So along with averaging down, you can get some serious losses because you're basically just compounding on your losses. So number four, what Williams O'Neill goes into is that public and common people love buying cheap stocks. Cheap stocks are there for a reason. He says the psychology is everybody likes to buy bundles of hundreds and thousands of a stock, thinking they own a lot, where instead of buying 2, 3, 4, 10, 20 stocks of a better performing or a higher, more expensive stock, what happens is everybody gets really attracted to the $2, $5, $10 stock, and that's the cheapness or the lower price attracts people, but they're there for a reason. They're underperforming the market, and I got stuck in this as well too when I used to buy random companies under the $10 mark, thinking one day they're going to hit $100 or 5-10x this, but they really didn't make that money back, and they were at that low evaluation for a specific reason. So number five, what Williams O'Neill says is that most people who start investing and trading expect too much out of the market. A lot of people who first start out trading and investing, and myself included, we thought we were going to become rich, overnight, and this is not really the case. Most of the time we come in underprepared and don't have enough tools and haven't had enough research to really do well in the market. So with this note, I really do think that you have to set your expectations properly. If you're just beginning and just starting to trade, it's going to take some time. You're going to take some losses. You're going to have to pay some tuition fees for these losses, but the learning experience, and some people don't even become profitable for a year or 2 years or 3 years, and some people don't even become profitable, but Just know and set those expectations properly, and then you'll set yourself up for a much better time than expecting to become rich overnight. So number 6 is that a lot of folks try and they buy stock that they hear from a rumor or advisory service and things that they hear from other people. What's kind of dangerous about that is that you haven't done your own research and you haven't done what most people call your due diligence. The issue and why you want to do that research is basically, and I say it sometimes as well too, is that you're only able to hold and invest in things that you know a lot about and you've done your own research and you're confident about that. When you listen to somebody else and you listen to somebody else's suggestions, you don't know what they're doing in the background, and that you don't know exactly what they're planning and what the game plan is in their head. And so it's really important for you to know and understand your strategy, your time horizon, and everything that is very specific to you during trading and investing. I used to do the same thing where I would listen to, somebody posted on stock twits or on Twitter or something like that, or a random stock, and I didn't look at the charts. I didn't, I just bought into it thinking that, this person seems like they know what they're doing, but I didn't have an exit plan. I didn't do the research, and I didn't understand why it was going in the way that it is. So always do your own research so that you have the confidence to hold your positions. Number 7 mistake, a lot of investors first buy second-rate stocks that have low dividends or low PE, which are price to earnings ratio. So the issue with low dividends is that the company's not able to give a lot of dividends because there's an underlying problem. They're not making enough money to give you enough of a high dividend. The other issue with the price to earning ratio is that a lot of people pick low PE ratios thinking that they got a good deal, or this PE ratio can move over time. The issue with that is that these dividends and the PE ratios are low for a reason. That means that there's something inferior going on with the business or with the asset that we don't know about and the market knows. So again, this kind of ties back with cheaper stocks. It's just stocks with low dividends and low PE ratios are there for a specific reason, and they're definitely more inferior, and the market knows something that we don't know. Number 8 is a lot of investors buy names that they know. The example in the book is that a lot of people invest in General Motors just because they work for General Motors. They know about General Motors, they've heard about it. A lot of the times just because you know of a company, and we can use, let's say, AT&T for a specific reason. Even though you know AT&T, you know Verizon, a lot of these companies are in a lot of debt, and they're actually, I would say, dying dinosaurs, and they're really part of the old economy. Just because you know about these major top name companies doesn't mean that they're good investments for you, and that there's actually other investments and other company names that you don't even know about, and that these could be better investments than just names that you typically know about. So that's another common mistake that most traders and investors do. Number 9 is a lot of people can't get really good information on trading and investing. There's a very small subset of investors and traders who do very well in the market. And then even when you do have that information, a lot of people don't even follow the advice of the very small subset, the 10% of people. A lot of people follow, 90, 80% of the other people who don't understand the stock market, who give actually very bad advice, and they're not outperforming the market. For example, goes into that, not a lot of major people make it to the major leagues, and that's a very small set of individuals. So listening to advanced financial advice, it's very similar. Make sure that you trust this person, they have a track record, and that they're able to show you what they've been doing for returns as well too. So number 10, and I think probably the most relevant tip for now in 2024, where everybody in every stock market is making new highs. We have new highs in the NASDAQ. We have new highs, all-time highs in the S&P 500. We have new highs in NVIDIA. We have new highs in cryptocurrency, Bitcoin. And the list goes on of all the things, gold also as well too. The list goes on with all the new assets that are hitting all-time highs. In the book, about 98% of the time, the masses are afraid to buy a stock because it hit an all-time high. And price-wise, it seems way too high for them, and when it's hitting all these all-time highs. And I also felt like this myself, and I did a video on this and went over it with you guys as well too, as Bitcoin, gold, and everything is making all-time highs. I felt a little bit nervous, and I felt a little bit negative for some reason about the market, and that's going to drop automatically now that it's hitting these all-time highs. But actually there's really nothing wrong with all-time highs, and it's actually pretty bullish that things are hitting all-time highs, and it's actually a good thing. So remember that, and remember that all-time highs does not mean that it's a bad thing. All right, number 11 mistake that investors and traders make is holding their losses for way too long. So I've been very guilty of this myself, and the book goes into that a lot of investors, even, and we learned that for part of trading, we're actually wrong about 50% of the time. The really good traders are right about 60% of the time. And what really benefits us is the risk to reward ratio. And even though we only are right 50% of the time, the risk and reward ratios help us make money in the long term. But a lot of folks hold on to their losers, and they hit their stop loss and they lost the 1 or 2 or 5 or 10% of that, what they were willing to risk. They hold on to that thinking it might come back, and then the average normal loss becomes a huge loss now. So don't fall into this mistake of just holding on to your losers for way too long. If it's past your stop loss and it's past your exit plan and exit strategy, make sure you exit, and so that you don't hold on to these losses and become so large that you can't overcome the loss. So number 12 mistake is very similar to number 11. So a lot of investors take really small profits, so they don't have an exit plan or a target price that they're looking for. And then as soon as they see that they made a couple of bucks or made a couple of percentage points, they take those winners and then they cash out on those winners. And then they actually leave the losses, and then they hold on to those losses thinking they could be winners as well too. So for number 12, what we want to do is actually hold on to our winners, let them run, let them continue to run until we hit our price targets, and then make sure we cut our losers quickly. For me, myself, I get to a point where I always leave some kind of, in crypto we call it a moon bag, in trading options and other things people call it runners. And so you basically exit the majority of your position once the price target hits, and then you leave 10-20% of that small bag to still feel like you can participate in the market, and then keep your winners running. So remember to always keep the winners, run your winners, and then cut your losers as fast as you can. So mistake number 13 is that a lot of investors worry too much about the taxes and commissions while trading. And this one, I fell very, very deep in the hole for this one in the last trade that I did. So basically I did a trade for some of the Bitcoin miners, buying some of the MicroStrategy and some of the other crypto stocks in anticipation for the ETF approvals. This was right around December time, and I wanted to push my taxes and some of my trades gains over into December, and I held it way too long. So the book goes into saying that, and I fell for this trap as well too. I was too worried and too fixated on like taxes and where to land on what year it is. And the main purpose as an investor, as a trader, is to make money. So no matter what it is, what you're doing, it's your main priority is to make money, and that the taxes and commissions should be a secondary thought. And because of that, because of that trade, I held on for way too long and ended up losing a significant amount, more than 50% of my profits on that, just because I held it for way too long, thinking I could push off the taxes into the next year. So just remember, that's a big mistake and something I just experienced for myself. I wish I was reading this at the time when I did that trade, is that not worry too much about taxes and commissions. Commissions are less of a problem now with Robinhood and some of the other commission-free systems, but I'm going to keep remembering that even for trading options contract, is that my main goal is to first make money, and then I'll worry about the taxes and I'll worry about the commissions at a later date. So mistake number 14 is that a lot of the market and a lot of new traders and investors speculate too much on options contracts. So we went over a little bit of the options trading. If you guys haven't followed it, make sure to follow me along, and I'll show you guys how to trade options and how I do it. The book goes into saying that investors and traders right now look for very short-term traders or contracts, and that they're really cheap and they're priced low for a specific reason. They're priced low because, like lower stocks, lower options and lower priced options, shorter priced options, and way out of the money options are very, very, very risky. To make money and to do this periodic over time, you need to understand some of the risks and control some of the risks. And a lot of the times, people don't speculate right, or they're too short-term in their options. Don't get me wrong, I have friends and I have people who trade zero DTEs, which are options that expire the same day, and they're doing fantastically well with that. That works out for them, but I personally, with my trading philosophy and how I do it, I would never do zero DTEs, just because it's too much management and too much risk for me to take on personally. And the last section about that, specifically with options, is that some people sell what we call naked options. So the opposite of that is called covered options, where you have the underlying asset that when the contract sets to expire, you have those shares to give away for the option contract. When you sell basically naked options, you have unlimited risk. So if a price goes up too high or too low, you can basically lose an infinite amount of money, which is a very scary thing, and something I never do in options trading is make sure I never blow myself up like that, where my account could be losing all my capital and then also ending up negative. So I think this one's super important. Make sure to follow me and to kind of go with this if you want to learn a little bit more about trading options. I know they're a little bit overwhelming with Greeks and with all the different intricacies and strike prices and expiration dates, but follow me and we'll keep you guys afloat with the how to trade options and make sure we don't blow ourselves. Mistake number 15 is that a lot of new folks and novice traders and investors do too many limit orders. So we talked a little bit about this when we did our options trading on Friday. Limit orders is when you basically want to put in like a bottom price or the exact pricing that you want to pay for the specific option or share. But the book goes into, it's just very similar to the taxes and the commissions. You're really overthinking about this, and I've taken kind of that philosophy as well too. A lot of the times now I just do a lot of market orders. If you're more sophisticated and you understand, you have charts and you have a game plan, sure, those limit orders and everything can work out well. But as a new investor, as an investor just starting your journey on this, keep things very simple. I'm going to try to work with you guys on this, and we're going to try to keep it with market orders. And about 80% of my orders right now that I'm doing for trades and investing are just market orders. Everybody's just way too concerned about the $1, $2, a tenth of a dollar difference, and then they miss out on that trade or they didn't get filled for that order. So just remember, when you're first beginning, don't worry too much about the limit orders. Worry about the market orders and make sure that you're focusing more on important things like stop losses and price targets, and then managing risks. The number 16 mistake is that a lot of investors and traders have really hard time making a decision when to buy and when to sell a stock. It's a lot of decision paralysis, and I used to experience this myself as well too when I didn't use charts. So use charts. Follow me, we'll kind of go through this. I'll show you guys how to use charts and how to use price targets and support and resistance levels, and that will help you understand and make decisions quicker, faster, more nimbly on when to buy and when to sell a stock. A lot of the times, and when I first started, I had no idea when to buy a stock. I would just hear something and from somebody or see a tweet or something like that and buy the stock, and then never know when to sell it. So that's the problem with having these issues and not looking at charts. And so I think charts are super important when you're trading or investing. You don't have to look at them all the time, but you do have to understand just the basics of it, and that's all you kind of really need. So remember, don't get yourself in trouble with this one, and make your decision process a lot easier for buying and selling stocks with technical analysis and some of the charts. So number 17 mistake a lot of investors make is that they can't look at a stock objectively. They're always hoping and having their favorites and having a specific viewpoint on the market. This is something I learned very well, and I hear a lot of traders and investors say about this. The market really doesn't care what you think. The market is going to do what the market does. And the best analogy that I've heard about this is that trading and investing is very similar to like surfing or any other sport like that. I love the surfing analogy just because the market it flows and it comes in waves. When trading, you're not in surfing as well too. You don't want to try to catch every single wave that you see. You want to try to catch the wave that looks right to you, has the right setup, has the right flow. It's not too dangerous. It's not near rocks, and that the weather's really nice, and that you're there and you understand that this is the time to get on the board, ride this wave. And investing and trading is just exactly like that. You don't want to force your way in saying, hey, this is the time I want to trade and this is the time I want to surf, and no matter what the waves are doing and what the ocean is doing, what the market is doing, you want to enforce your will on it. Like the ocean, like the market, like nature, things are going to be doing what they intend to do, and your job as a trader or investor is to make observations, see what things are doing, and then making sure that we ride the right waves and we make the right investments, and that will put us on the right foot for investing and trading. And finally, the last advice, and number 18, is that a lot of new investors and traders are influenced by things that don't really matter. So a lot of the things people worry about are stock splits, increasing dividends, news announcements, some of the rating agencies' recommendations to buy and sell a stock. At the end of the day, a lot of those things don't really matter. What really matters for a company, and a lot of investors and traders look at, is price action. So the price and what it looks like on a chart is the main arbiter of truth. How a company is doing, how the market is doing, how everything is doing is reflected in the price. So, and that price has all of those minor components and those non-critical pieces, and it's baked into the price. So the price, again, and we'll kind of go through this and reiterate this process with you guys, is that price is the most crucial thing to take a look at, and that's some of these other things that people talk about of, new products, new things that the company is doing, stock splits. That's not really the important thing. The really important thing is to look at the charts, have an entry and exit plan, and then make sure that we're risk managing a lot of our investments and a lot of trades very, very well. So those are the 18 major mistakes new traders and investors make when they're first starting out. Again, I fell into a lot of these as well, and I wished I had a video like this to kind of walk me through it. So if you're new to trading and investing, I hope you found this helpful. If you want to continue to see how I invest and I trade, make sure to follow me. If you enjoyed the content, like the video, and I'll catch you guys next time. And when I finish up the full entire book, I'm going to be doing a summary, so we should be seeing it right here, and to watch this video for the whole entire book on Market Wizards. You guys had a good weekend, and I'll catch you guys next time.